There's a few key things that all of the best companies I've met have in common. One is a deep ownership culture. Every level of the organization, there is the desire to do the right thing for the customer in the form of creating a great product, and efficiently and prudently targeting that and investing, and also having longevity. They've been the major drivers of the best businesses over time. It's when you've got a good product, a good business, and you consistently do the basics very, very well over a number of years, and if you do that for long enough, you end up creating economic moats which are far greater than what your competitors can penetrate. And one of the, on the flip side, the worst companies, or the more difficult companies that I've found over time, have been those that have been managed for short-term incentives, have been very aggressively run from a growth perspective. They've tended to overinvest in their businesses to report short-term positive numbers, and down the road that's led to problems with balance sheets and the need for additional capital. And really, the best companies that I've found are those that identify their opportunity set, and they don't worry about the growth rate being a certain level above or below their peer group. They just execute on a good product, and they consistently execute on that well, and they pay out their excess cash to us in the form of dividends, the shareholders in the form of dividends, and don't get dragged off into reckless diversification into new product areas, over-investment, which ultimately kills the core of the business. It's about not being distracted, actually. That's one of the kind of key promises. And as I said, ownership culture throughout the organisation, and a depth of management. It can't just be a one-man show. It has to have levels of ownership and an institutional structure underneath it to provide longevity to the business, which is ultimately what drives compounding year in, year out in good companies that you want to own for as long as possible. I think a lot of it comes back to the incentives. I mean, I said this at the outset, but governance is the bedrock of the approach, and it's really because of the fact that governance is what drives capital allocation decisions, and governance is therefore what drives the returns and the cash generation of a business, drives the growth rates of the business, and determines what the value of a business is. And if management teams are improperly incentivized, so they've got stock options as opposed to real shares, the share option program may be relatively short term in nature. Maybe I like to see management teams that have come through an organization as opposed to being parachuted in, because I think they've got more longevity, they've got more personal investment in the business, and that ownership culture tends to run deeper in that nature. It's more than a financial problem if it goes wrong for them. Whereas you tend to have, in large corporates, one of the problems in global multinationals as well can be what becomes a bit of a revolving door of CEOs. New guy comes in, 2, 3, 4 years, moves a few things around, then leaves, and the next one comes in. And I find that to be a little bit challenging. I like to see managers come through an organisation.